man should look for what is and not for what he thinks should be. This is real key in this market, because I meet with people every day, and they ask questions like, how long do you think this market will last? Should I sell now? Will I be selling at the bottom? Should I be buying more? And the reality is that in any investing, you have to look at the environment that you're in, and you have to invest in the environment that you're in, not the one that you hope to be. There's a lot of people out there hoping that the markets will turn around, hoping that there will be a bull run here. But the reality is that when you have a declining market, you have to go with the trend, and you always have to default to what that trend is until it changes. And in this particular market, until you see the Dow Jones get back well above 9,000 and stay above 9,000 for an extended period of time, you don't have a trend change. So you have to look at that. And when I was doing my homework, I started to realize that bear markets don't last just for 1 or 2 years. They go through cycles. And this graph, and you'll have this in your packet too, goes through the history of bear markets all the way back to 1900. And what you'll find is that you go through a period of, I'll start right here. We go through a period of asset collapse, like we did in the Great Depression. You go through a period of rebuild, period of growth, and right here in the 40s and 50s, we went through an extended bull market that lasted for more than a decade, went on for 20 years. Well, in order for a bull market to be created and continue, you have to have the fundamentals of the economy behind it, which means companies have to be earning more money this year than they did last year, or more money the following year, and so on. In order for that to happen, the whole fundamentals from economic policy, politics, everything has to come into support. Well, in the 50s we had that, because after World War II ended, all the GIs were coming home, everybody was starting families, buying houses. Eisenhower came into office, put a huge public works program into place. One of the biggest was the I-5 and just the whole nation's interstate highway system. So imagine the economic stimulus that happens when you put people to work to build a highway system, the commodities that are needed. And then from that, it compounds, and you have one thing built upon another. During that time, that's also when the aerospace industry started to be built. That's when airlines came out, and people started flying from this place to the next. And you had more efficiencies starting to be created within the economy. So you went through a 20-year period of growth. Well, when you go through a 20-year period of growth, some of that growth it feeds on itself, and then you have to digest it. It's kind of like in 01 and 02 when Ford and GM came out and dropped interest rates on cars to 0%. Well, everybody ran out and started buying cars. But once you have a car, you keep it 5, 6, 7, sometimes 10 years. So they front-loaded a lot of sales in 02 and 03, and then afterwards, there was nothing else to buy. Everybody already had a car, they didn't need it. Same thing happens in an economy. A lot of things get front-loaded, so it takes time for it to digest. So you go into a period of a plateau, okay? And that plateau usually starts with a mild recession, recovery, a collapse in prices like we had in the mid-70s, recovery again. And these types of plateaus are typically seen in times of high inflation, which is what we had in the 70s. I remember as a kid standing in front of my mom's car. We had a big Buick. I remember standing in front of the car because our license plate had an odd number and it was an even day to get gas. You guys remember the odd and even days? Something hopefully we never see again. But the 70s were a time of recessionary, bearish markets due to high commodity prices, due to high inflation, which was the result of a manufacturing boom that we had in the U.S. So after that plateau happens, we go back into a phase of growth, 80s and 90s. Now that wasn't based on manufacturing, that was based on services and technology. Because in the 90s we built another highway, and it wasn't the regular highway system, it was the internet. And that efficiency that came into companies was amazing. We watched our broker dealer, who handles all of our back office operations, we watched them grow from 300 representatives to almost 700 representatives, and their communication costs actually declined. Because to send an email cost nothing, whereas phone calls and faxes did. So over the years, throughout the 90s, we had this boom within business because the efficiencies of technology. It brought costs down and allowed us as an economy to shift from manufacturing to service, and we outsourced manufacturing to other areas like China and India. After there, again, we go through this period of growth, we have to go in and digest it for a while. So 2001 comes around and we have a recession that hits us. And we go through this first mild recession. We rebuild in prices because 03, 04, 05, 06, markets came back to even. And then now we come into these years, 07, 08, and now 09, where we have an asset collapse. So is the asset collapse go on? What's going on? What is the next phase? Well, if you go out and you do your homework, and you do a little homework on this guy, Kondratiev, he was a Russian scholar that in the early 1900s, he put together the first Soviet 5-year plan. He was actually thrown in jail by Stalin and then executed because Stalin didn't like what he was saying. Well, he was the guy who named and called the Great Depression because he talked about economic cycles that go through long waves, 50 to 60 years based on life expectancy. We actually now find that they last about 70, 80 years because people are living longer. But what he would talk about is that economies, especially capitalist economies, will go through a period of growth, plateau, growth, another plateau, but that fourth plateau has an asset collapse, what they call a winter phase. Because when you go through a time like we did in the 90s, where most of the growth was based on service and consumption, there's a change that happens in psychology and in sociological senses about work ethic. People become more greedy rather than working hard. Might sound familiar with what's going on in the banking sector. And you also go through a policy change. We just went through 20 years where the policy was lowering taxes and deregulation. What will the next 20 years hold? Well, most likely what we're looking at over the next 20 years, if you follow these cycles, is more regulation and higher taxes. Not a great environment for investors. Doesn't mean you can't make money, but it means that you got a headwind against yourself and you have to broaden your horizons on what you think or what your traditional sense of investing and where you can make money is.